So you've watched my video on Roth IRAs and 401ks and you finally opened your first retirement account. But now you're faced with a new problem. What do you invest in? Through pretty much any brokerage, you have thousands of options for how to invest your money. And especially if you are first starting out, this can be incredibly daunting. Do you invest in individual stocks? Do you invest in mutual funds? Or do you maybe even invest in bonds? The options are endless, and it often leads to new investors facing analysis paralysis, stuck and not investing their money simply because there are so many options and they're afraid to pick the wrong one. In today's video, I'm going to be covering the basics of some of the options that you have for investing your money. And at the end of the video, I'm going to cover what I personally recommend and what I'm currently doing. If you're new to the channel, welcome. My name is Tyler Warlow, and I make videos on how to improve your life through your confidence, capabilities, and overall happiness. Just a quick disclaimer, I am not a finance professional. I'm just some guy on YouTube talking about his personal recommendations and what has worked for him. So before you make any of your own decisions, be sure to do your research, and any decisions that you do make are your own. Now that we've got that covered, let's jump into the video. So if we're going to be covering the basics of investing, we have to start off with something that most people have heard of, and that would be stocks and bonds. So first, let's take a quick look at stocks. Owning a stock is owning a representation of ownership of a public company. In other words, if you buy a share or a stock from a public company, you own a certain percentage of that company. One thing to note with stocks is that their price tends to be volatile and subject to how the company is doing overall. As a result, they tend to be considered a riskier investment. Generally, the potential for reward with stocks is quite high, and that's why you hear about a lot of people getting rich off of picking stocks that ended up blowing up, such as Tesla or Google or Microsoft. But one thing to keep in mind is that it's incredibly hard to know which one of these stocks is going to be successful. And just like how you can win some great rewards from stocks, it can be incredibly easy to lose a lot of money as well. There are two main ways that you can make money by owning stock. And the first way is going to be dividends. Dividends are when a company chooses to pay its shareholders a certain amount of money for each share of stock that they own. You can pretty easily find this information online, and it's generally not as much as you would think. But as you build up the amount of stocks that you have, the money starts to add up. The other way that you can make money with stocks is what most people think of, or capital gains. Capital gains are achieved when a stockholder sells the stock that they own for a higher price than what they bought it. But like I said earlier, just like how you can make some capital gains, you can also make some capital loss. Now that we've got the basics of stocks covered, we will go ahead and jump into bonds. When you purchase a bond, it's a little bit different than a stock. It does not give you any sort of ownership of the company at all. Bonds represent a loan from the buyer, or you, to the issuer of the bond. Bonds can be issued by the government or any public corporation for that matter. And the issuer of the bond has to pay a stated interest rate. Bonds are typically considered a safer option as they kind of give you guaranteed income as long as the company or government is able to pay off their loans. So unless the government or company is in some really hot water, you've pretty much got some guaranteed income. That guaranteed income typically comes from the interest rate stated on the bond. So you might be wondering, well, if that's the case and they're considered safer than stocks, why wouldn't I just buy bonds? Well, typically, bonds have a pretty low interest rate, so you're not going to be making as much money. It's typically better for people who are at a point in their life that risk might be kind of bad for them, like people who are already retired, but they still need some sort of stream of income. So while you'll generate a little money, it's not going to be nearly to the same amount as what you might make with stocks. So real quick, I'm going to cover some good information to know in terms of bonds. First, the coupon rate is the interest rate that I've been discussing while talking about bonds. Second is the maturity date, or when payment is due to the person who bought the bond. And finally, the par value amount is the amount to be paid to the bondholder once the maturity date is reached. So So now that we've got the basics of stocks and bonds covered, we can kind of move into some more complex topics. But first, if you have found the information in this video to be helpful or informative so far, please be sure to leave a like and subscribe to join me in this journey of self-improvement. Also, if you would like me to make a video that covers any of these topics more in depth, or you have any questions, please leave a comment down below. I like to read as many of them as possible, and it really makes my day. Thank you in advance, and now let's move on with the video. I mentioned that I'm going to cover a little bit more complex topics, and that's going to be covered in the next 3 things that I mentioned. Some potential investing options that you may have heard of are mutual funds, index funds, and ETFs. And I'm going to go over what each of those are a little bit. So firstly, all of these are a type of fund, and these funds all offer the ability to incorporate diversification within your portfolio. In other words, these funds tend to have several different types of stocks that fall under them. And by buying a share of the fund, you are owning a small percentage of all of the different stocks that fall under that fund. So now let's jump into the individual funds a little bit. So coming in first, we're going to talk about mutual funds. Mutual funds pools the assets of all the investors that are investing to the fund and invest them into different things such as stocks, bonds, and etc. The main thing that sets this apart from index funds and ETFs is that they are actively managed. In other words, there is an individual that is actively choosing the assets that will go into this fund. Because there is someone who is having to make these decisions, they have to be paid somehow. And this is typically done through the fees that the fund will charge. Mutual funds will typically charge a higher rate than the 2 other funds that I have mentioned, usually sitting around about 1% of the total funds that you yourself have invested into it. So next, we're going to talk about an index fund. Index funds are meant to track and return exactly what it sounds like, a specific index. It's supposed to reflect what the market is actually doing. One of the most common types of index funds are going to be funds that track the S&P 500. By purchasing a part of this fund, you're purchasing a small percentage of every single company that falls into the S&P 500. Because it is simply following an index, there is no one who is actively managing this fund. It's pretty simple to set up a computer program that simply buys and sells based on what is in the index. Because there is no one who is actively managing this fund, the fees are typically much lower. And this is going to be a very good segue into an ETF, or an exchange traded fund. ETFs are actually very similar to index funds in the sense that they are meant to track a particular index. Now, the main difference between this and an index fund is with index funds, you can only buy or trade once a day, versus with an exchange traded fund, you are able to buy and exchange through the entire day like you would with a stock. You can purchase them through pretty much any brokerage just like you would with a stock. There tends to be no minimum investment required, and it tends to give you a little bit more flexibility with your money. A lot of ETFs also typically offer the option to buy partial shares if you don't quite have the money to buy a full share. But now that we've covered the basics, I'm going to go over what my personal recommendations are. If you are investing for retirement, you want to be consistent. That's really the name of the game. By being consistent, as I covered in my video on Roth IRAs and 401ks, you're allowing compounding interest to really do its job, and it gives you that larger and larger return over time. The data has shown that most actively managed funds where people are trying to beat the stock market tend to actually fail to beat the market. Personally, if you're investing for the long term, it's best to just set it and forget it. And I find that it's easiest to do that with an index fund. Index funds are meant to return exactly what the market returns. And over time, even though there have been dips, the market has always gone upwards. So you're almost guaranteeing yourself positive returns as long as you consistently put money into it. One thing to keep in mind here is that you should not sell everything if the market takes a dip. If anything, that's the perfect time to be buying because shares are lower. But again, I stress that investing consistently is really the key. So I would set a monthly investment amount to buy from an index fund every month and then set it and forget it. There's other options that also incorporate this, such as target date funds, but target date funds could really be its own topic entirely. You might be wondering why I advise an index fund over an ETF. And it's like I said, generally, if you're just trying to invest for the long term, you want to be consistent about it. So the added liquidity of an ETF doesn't serve much benefit there. That's why I personally would choose an index fund over an ETF. And again, the fees for an index fund are going to be much lower than that of a mutual fund. While it may not seem like that big of a difference at the start, this can save you literally thousands of dollars in the long run. But that's going to bring us to the end of today's video, everyone. If you found the information to be helpful or informative at all, please be sure to give it a like and subscribe and join me in this self-improvement journey. It helps spread the channel to new people who might not otherwise know the information. Additionally, if there's any types of topics or information that you would like to see me cover, please leave a comment down below. I love to read all of them and I like to respond to as many as I can. But if you're interested in more videos where I cover financial topics, you might want to check out this video right here, where I cover what financial independence is and how you can reach it. If you're more interested in some of my most recent stuff, be sure to check out this video right here. But until the next time, this is the Mengineer, signing off.